We now move to section 4, enterprise value multiples. There are 3 subsections. Here we'll talk about enterprise value to EBITDA. This is the most popular enterprise value multiple. Then a brief discussion on other enterprise value multiples, and finally a short segment on enterprise value to sales. Enterprise value to EBITDA. As I'm sure you are aware, EBITDA is a flow to both debt and equity holders, because this is the money that is generated, or this is actually an amount before we subtract taxes, depreciation, amortization. So it goes to both debt holders and equity holders. Enterprise value is a value of the total company, which includes debt and equity. And this ratio, enterprise value to EBITDA, is the most widely used enterprise value multiple. Hopefully you recognize the fact that both the numerator and the denominator are taking a holistic perspective. By holistic, I mean we are covering all investors, both debt holders and equity holders. What are the rationales for using this particular multiple? The first one is that EV to EBITDA is usually more appropriate than the price earnings alone for comparing companies with different financial leverage. The second point is that by adding back depreciation and amortization, EBITDA controls for differences in depreciation and amortization among businesses. For this reason, EV to EBITDA is frequently used in the valuation of capital-intensive businesses. And finally, EBITDA is frequently positive even when EPS is negative. You need to remember these reasons, and they are fairly straightforward. What are the drawbacks? EBITDA will overestimate cash flow from operations if working capital is growing. And hopefully you recognize this. If working capital is growing, what does that do to cash? It is a use of cash. Is that use of cash captured in the income statement? It is not. So since that use of cash is not being captured in the income statement, EBITDA, which is an income statement item, will be overstated. EBITDA also ignores the effect of differences in revenue recognition policy or cash flow from operations. The point being that if you are comparing different companies which are similar in all respects but have different revenue recognition practices, then obviously EBITDA, which starts with sales, will be different. Free cash flow to the firm, which directly reflects the amount of the company's required capital expenditures, has a stronger link to valuation theory than does EBITDA. Only if depreciation expenses match capital expenditures do we expect EBITDA to reflect differences in businesses' capital programs. So all this point is saying is, theoretically FCFF is better than EBITDA in the denominator, but EBITDA is much easier to come up with, so you will very often see this multiple being used. In fact, as has been mentioned up here, in the real world, in practice, EV to EBITDA is easily the most commonly used enterprise value multiple. So how do we estimate enterprise value? This is a formula that you saw at level 1 and you've seen again earlier in our curriculum. The enterprise value for a firm, or the enterprise value, is the market value of common equity plus the market value of preferred stock plus the market value of debt, less any cash and investment. So marketable securities that are not directly part of the operations of the company need to be subtracted to come up with enterprise value. The curriculum gives a long example, example 34, which describes this calculation. And if you have time, you can go through the example, but here is the relevant excerpt. We are given a company and we are given the balance sheet and more information. And from that balance sheet and the additional information provided, we first come up with enterprise value. And how do we do this? This is the market value of equity. We are given the stock price, and from the balance sheet, we are given the number of shares outstanding. So we multiply the two and come up with this number. This is the market value of debt. And if the market value of debt is not easily known, then you often use the value of debt from the balance sheet as a proxy. If you know both, if you know the market value of debt and the book value, then what should you use? Then you should use the market value. If you don't know it, then your best assumption is that the book value represents the market value of debt. And then 949 is the value of short-term investments. So you subtract that number and come up with enterprise value. Then for the denominator, which is EBITDA, you use the trailing 12 months, and we don't need to get into the details, but essentially this is the number 1479. So what is the multiple? The multiple is 7004 divided by 1479. This will give you your EV to EBITDA multiple. Valuation based on forecasted fundamentals and comparables. So let's talk about forecasted fundamentals first. Justified EV to EBITDA is arrived at by dividing the enterprise value of a company based on a valuation model such as FCFF by the company's actual or forecasted EBITDA. All this is saying is that to come up with the multiple EV to EBITDA, you have to come up with the enterprise value. And this is saying that you arrive at the enterprise value using a model such as the FCFF model. So take a very simple company that does not have any marketable securities, just for simplicity, or marketable securities are close to zero. What is the enterprise value? Assuming Gordon growth, assuming that a company is growing at some sustainable rate, the free cash flows are growing at some sustainable rate, the enterprise value will be FCFF at the end of 1 year divided by WACC minus G. So what does this give you? Does this give you the market price, or does this give you what you believe the value should be? This gives you what you believe the value should be. So when we talk about the justified multiple based on fundamentals, it is simply this enterprise value that you have calculated using your fundamentals, the FCFF, WACC, G, etc. And then you divide the number that you get by EBITDA. So it is very straightforward. How is this different from taking the market value of debt, market value of equity, and then dividing by EBITDA? That would be the actual multiple based on market prices. So if you have the actual multiple based on market prices and you have this multiple, you can compare the two multiples to figure out whether the company is overvalued, undervalued. If the market multiple is low relative to this justified number, then the security or the company is attractive. All right, now the justified EV to EBITDA is positively correlated to expected growth rate in FCFF. What does this mean? This is a standard concept that we've discussed before. If the growth rate is relatively high, then what will happen to the justified multiple? The justified multiple will be relatively high and negatively correlated with the cost of capital. So if the cost of capital is relatively low, then obviously our multiple will be high. Again, this is the justified multiple, the multiple justified based on the fundamentals. Valuation based on comparables. How do you do this? We'll see this in an example on the next slide, but you take a group of peer companies or you take the industry, you come up with the benchmark value for EV to EBITDA and compare that benchmark value with the multiple for the company that you are analyzing. If the company that you are analyzing has a low multiple relative to the industry or the peer companies, then that means that this company is probably attractive, all else equal. So this is an excerpt from example 35, which illustrates what I am talking about. Just a few points that I want to highlight. These are the various peer companies that we are looking at, and the example gives us several pieces of information: the price, shares outstanding, market cap. There are some items that might not explicitly be mentioned in the learning objectives, but I think you should still know these items. So notice this term, total invested capital, TIC, and enterprise value. I want you to stare at this data. And I know you've not seen TIC before, but based on looking at the information presented, think about what's the difference between TIC and enterprise value. The only difference is this cash item. So with TIC, we do not subtract the value of cash and marketable securities. If cash and marketable securities are a small number relative to debt and equity, then TIC and EV will be roughly the same. All right, now, next what I want you to do is look at these multiples and ratios and come up with whether WDC is an attractive investment or not. So if you look at the numbers, let's start with the most important ratio, at least in the context of what we are studying, which is EV to EBITDA. As we've said, all else equal, a low number means that the security is attractive. So this is selling, or this is at a relatively low multiple compared to this company and this company. But it is higher than STX. So purely based on EV to EBITDA, STX seems to be better. What about based on total invested capital to EBITDA? There also STX seems to be better, even though WDC is better than these two companies in the middle. Return on invested capital, this is an important measure. Return on invested capital is NOPAT, net operating profit after tax, divided by the invested capital. So obviously, the higher the better, all else equal. Here with this ratio, again, this company, STX, seems better. But when you look at the debt to equity ratio, the debt to equity ratio for STX is more than twice the debt to equity ratio of WDC. So while STX does seem to have more attractive multiples and a better ROIC, but it also appears to be a lot more leveraged, so probably more risky. And then if you look at the growth rates, the quarterly growth rate, 49.7% for WDC. So absent any other information, this looks very attractive relative to the other options over here. So all in all, WDC seems definitely better than NTAP and EMC. And there is some debate as to whether WDC is better than STX. In some ways, STX looks better. In other ways, WDC seems better. Our conclusion is that we need to look further into WDC and STX. All right, some other enterprise value multipliers. So if you look over here, the item that we have focused on is EBITDA. All we are looking at is alternative denominators. What is the numerator? The numerator we are assuming is EV. So what do you have in the denominator? The other possibilities are FCFF, which theoretically is appealing, but at times might be complicated to calculate, EBITDA and EBIT. And these are definitions that you know. Just be aware that if you see another denominator, then you should not be frazzled. Other denominators can be used. All right, next point. Section 4.3, enterprise value to sales. This is a short segment. I don't think it's overly important. I'll just read the little paragraph from the curriculum and highlight what you need to know. Enterprise value to sales is a major alternative to the price to sales ratio. Do you remember this ratio? We talked about this earlier with the PE ratio and price to book. But there's a fundamental issue with price to sales. The price to sales multiple has the conceptual weakness that it fails to recognize that for a debt finance company, not all sales belong to equity investors. So the P is the price of a stock. So this obviously is a common stock or equity holder perspective. But the S is not purely an equity holder perspective, because the sales, in a sense, first go to debt holders. Once they are paid off, then the shareholders get their part after that, after the expenses have been paid off. Some of the proceeds from the company's sales will be used to pay interest and principal to the providers of the company's debt capital. For example, a price to sales for a company with little or no debt would not be comparable to a price to sales for a company that is largely financed with debt. Enterprise value to sales would be the basis for a valid comparison in such a case. In summary, enterprise value to sales is an alternative sales-based ratio that is particularly useful when comparing companies with diverse capital structures. And this is illustrated in example 36. I'll not be doing it, but if you have time, you can review this example. Section 4.4 is not testable. It is basically general knowledge. You can take a quick look at this. All you have here is different sectors or different industries, and you are given the PE ratios and some other fundamental statistics for different US-based industries. Section 5 is a short little segment on international considerations when using multiples, and most of this is something you probably know already. Using relative valuation methods in an international setting is difficult for several reasons. And what do we mean by this? The point here is that if you are comparing a textile company in South Asia with a textile company in North America, it is not that easy to just start comparing the price to earnings ratios or price to book value ratios. Why? One basic reason would be differences in accounting methods. And we've done this over and over. Level 1 FRA, level 2 FRA. If companies in different parts of the world are using different accounting standards, then any accounting related measure such as earnings or EBITDA or book value is going to be influenced by the accounting standard being used. Having said that, ratios such as price to cash flow, be it CFO or be it FCFE, would be relatively less impacted by accounting differences. Another point has to do with cultural differences. If a country by and large tends to be more risk averse, that is going to impact stock valuations, which will then also impact the multiples. Economic differences can have a huge impact. If a given part of the world is experiencing a tremendous amount of growth, then obviously, fundamentals such as G and cost of capital and so on will be very different from other parts of the world which have a different economic situation. So bottom line is that you need to think real hard before simply comparing ratios for companies that are operating in different parts of the world. Next point, or next section, momentum valuation indicators. You might recall a reading in level 1 quant called technical analysis, and this is essentially an excerpt or taken from that particular reading. So this is technical analysis in the context of multiples. Fortunately for us, this is not a very long section, and we simply cover 3 representative momentum indicators. The reason we are saying 3 representative indicators is there are lots of indicators. We are just going to talk about 3 of them. One is earnings surprise, then standardized unexpected earnings, and relative strength. So what does earnings surprise mean? If you are studying a given stock, any publicly listed company is obviously going to have periods where they announce their earnings for a quarter that has just completed. And analysts are typically following that company, so analysts have expectations about what the earnings number will be. There is this number called the consensus estimate, which you can think of as the rough average of the various estimates. So that is the expected value of the earnings per share. When the company actually announces the earnings per share, it is possible that the earnings per share number is different from what is expected. So if analysts are expecting $1 per share and what actually is announced is 1.05, then what is the earnings surprise or the unexpected earnings? It's 1.05 minus 1, which is 0.05 cents per share. Related to this measure is something called scaled earnings surprise. So is this 0.05 surprise a big deal or not? One way of figuring that out is to take the unexpected earnings or the earnings surprise number and divide by the standard deviation of the analyst's forecasts. A simple example is given here, number 37. You have a given company and the mean consensus forecast is 1.53. Then the actual EPS turns out to be 2.4. There are several analysts who are following this stock, and the standard deviation of the analyst's expectations is equal to 0.28. The scaled earnings surprise is 3.11. So this is going to be the difference, 2.4 minus 1.53 divided by the 0.28. So notice that if there is a large standard deviation, which means that the different analysts are spread across a wide range, then a number that is different from 1.53 is not that unexpected. Another measure which is referenced more often is the standardized unexpected earnings, or SUE. Now what is this? The numerator should look familiar. This is again the EPS that is actually announced minus the expected value of the EPS. But this is now divided by the standard deviation of past unexpected earnings over some historical period. So you might have a period of say 2 years, and over those 2 years you look at all the unexpected earnings for this particular company. It might be that last quarter the unexpected earnings was 0.05, the quarter before that the unexpected earnings was 1, before that the unexpected earnings was 0.10, and so on. So you take a certain period, let's say 2 years, and you find the standard deviation of the unexpected earnings over that period. If you have a company where the standard deviation of these unexpected earnings is very low, that means that for this particular company, historically, the earnings number that is announced is typically close to the earnings number that had been forecasted in the past. So if that company has an earnings surprise, it's a much bigger deal relative to a company that has a history of having earnings surprises. So that is captured by this measure. You might be wondering why we are talking about this. What is the rationale for worrying about earnings surprises? There is some evidence, some empirical evidence, that positive earnings surprises may be associated with persistent positive abnormal returns, or alpha. And you might recall this as one of the anomalies that you studied at level 1. Typically, companies that have a positive earnings surprise, at least in the short run, tend to perform well. So one possible trading strategy is to buy stocks which have just announced an earnings number which is higher than what was expected. So buy stocks which have positive earnings surprises. So this is example 38, which illustrates the unexpected earnings for two companies. So we have Sony and Philips. I want you to look at these numbers. So we have several quarters of data. If you look at the most recent quarter for Sony, what was the consensus EPS forecast? Minus 6.3. What was the actual EPS? 28.9. What is the percentage earnings surprise? Where does this number come from? This huge number. This is the earnings surprise, which is the difference divided by the forecast. What does this standard deviation of 8.34 mean? This is the standard deviation of earnings surprises in the past for that same company. All right, so a relatively high standard deviation number means that this company has a history of earnings, relatively high earnings surprises. Now, where does this number 4.22 come from? And I want you to calculate this before looking at the solution. So to come up with 4.25, what we say is the actual EPS 28.95 minus 6.3, which becomes a plus, divided by standard deviation, and that will give you this particular number. So that answers our first question. Then the next question is, based on these exhibits, for which company were the consensus forecasts less accurate over the past 4 quarters? If you look at the SUE score for Sony, you have a large number, 4 point something and 4 point something over here. But for Philips, the numbers are generally 1 or less, like it's minus 1, 0.7. So it is in a much narrower range. So what this means is that the earnings surprises were far greater with Sony. The next question is, interpret the amounts of the percent surprise and why are the signs different over here? So why do we have a minus for percent surprise whereas a positive for the score? This has to do with the definition of this percent surprise. Percent surprise is the surprise divided by the forecasted EPS. The surprise itself is positive because the actual EPS is greater than the forecasted number. So the actual EPS is actually much greater. So how do you calculate this surprise? It is the actual surprise, which is a positive number over here, divided by the forecast, which was a negative number. That's why the percent surprise is negative. The SUE score is positive because this is the surprise, which again is positive, divided by the standard deviation, which has to be positive. If you look at this number over here, why is this negative for the SUE score? This is negative because in the quarter that we are talking about, the surprise is negative. The actual turned out to be less than what was forecasted. Surprise is negative divided by standard deviation, which has to be positive. You get a minus SUE score. The percent surprise is negative. Why? Because you have a surprise which is negative divided by the forecast, which in this case is positive. The third measure we'll talk about is relative strength. Relative strength indicators compare a stock's performance during a particular period to its own past performance or to the performance of some group of stocks. So you can have a price momentum indicator which compares a stock's performance during a period with its past performance. If a stock in the past has been growing on average at 8% and now it is suddenly growing at 12%, we'll say that it has strong momentum. Something that is used more often is you look at the performance of a stock or a sector relative to an index. So generally it is with a particular stock. You look at the stock's performance divided by the performance of an equity index, and this is easier understood visually. If you are in a market, let's say you are in the US market, and the S&P 500, which is a major index, is going up slowly, but a particular stock is going up at a much faster rate, then the rate of growth of the stock divided by the growth rate of the S&P 500 will be more than 1. And that would indicate the fact that the relative strength of this stock is positive or strong. So what is the rationale for relative strength? Patterns of persistence or reversal exist in stock markets. Now, this is the underlying theme behind technical analysis, that if a particular stock is performing very well, at least for the short term, there'll be some pattern, or in the short term, it will continue to perform well. But also note that investing strategies based purely on technical momentum indicators are inherently self-destructing. What that means is, if everybody in the market knows that this particular stock is going to do well, what will happen? Automatically people will buy, the stock price will go up, and it will no longer be a valuable stock to buy. So it will no longer be attractively priced. So practically speaking, how do practitioners operate? What practitioners do is they often use fundamental analysis, and then in addition they might use technical analysis to see what is the momentum. Is the momentum positive or not? Section 7, which is the final section in this long reading, some issues in practice. Some issues that arise in practice when averages are used to estimate benchmark multiples include the following. What definition of mean to use? And another issue is one that you have memorized maybe or heard of at level 1, called look-ahead bias, and here we'll actually understand what this means. Now, to set the context here with what definition of mean, this is important because when we talk about the PE multiple of a given stock, then we say that the stock is overvalued or undervalued relative to the PE of a benchmark. The benchmark would be maybe the average of the PE of a bunch of representative stocks. So what average do you use? Should you use the weighted average, the geometric average, a plane average, a harmonic mean? So what average to use? And the answer is that the most theoretically appropriate mean to use when you are coming up with a mean of a ratio such as PE is the weighted harmonic mean, and we'll see why. Analysts often apply the weighted harmonic mean to average a group of price multiples. And in the example that I'm going to show you from the curriculum, the weighted harmonic mean precisely corresponds to the portfolio PE of 12.9. So where are these numbers coming from? To illustrate the point, the curriculum identifies a very simple portfolio of two stocks, stock 1 and stock 2. The market cap of stock 1 is 715, market cap of stock 2 is 585, and then in your portfolio, percentage of stock 1 is 55%, percentage of stock 2 is 45, and these are the earnings numbers, 71.5 and 29.25. So if you take the whole portfolio 1 and 2, what should the PE of this portfolio be? It should be the sum of the earnings numbers, 71.5 plus 29.25. So collectively this will represent the total earnings. The total price is essentially the total market cap, 715 plus 585. So if you add these two numbers and divide by the total earnings number, you will get 12.9. If you want, you can pause the video and make sure that you get that number. So we have a PE for stock 1 of 10 and stock 2 has a PE of 20. If you simply take the regular arithmetic mean, what do you get? You get 15, which is quite different from 12.9. What if you take the weighted mean? So that is being done over here. So you weight based on market cap, 55% into 10 and 45% into 20. There you get 14.5, getting better but still not at 12.9. Then you take the harmonic mean, and you might recall from level 1 quant, harmonic mean is given by this formula where n is the number of securities, and then you sum up the reciprocals. So When you use this formula for the harmonic mean, you come up with 13.33. So we are getting closer. But when you use the weighted harmonic mean, then you get exactly the right answer. So weighted harmonic mean is given by this formula. 1 divided by the weight over the value. So that's shown over here. 0.55 into the reciprocal of the PE. PE is 10, so this is 0.1 plus 0.45 into 0.05. You get this number and take the reciprocal and you will get 12.9. So the weighted harmonic mean gives you the most appropriate answer. Now, what does this mean in practice? In practice, if you are coming up with your benchmark PE and you have 10 stocks in your industry that you feel are comparable, then you take those 10 PEs and you take the harmonic mean of those 10 PEs, and the harmonic mean is probably an appropriate benchmark. More on harmonic means. Harmonic means tend to mitigate the impact of large outliers. You might recall from earlier in the reading where we talked about mean versus median. And the regular arithmetic mean is heavily influenced by outliers. So clearly the mean is not as good as the median. And now we are saying that probably the harmonic mean is an even better. The harmonic mean also tends to mitigate the impact of large outliers. So it is not as impacted by large outliers compared to, say, the regular mean or the arithmetic mean. But the harmonic mean may aggravate the impact of small outliers. What is the good thing about small outliers though? The small outliers will be bounded at 0. A large outlier can be a very high number, but a small outlier is still bounded. And then this exhibit simply shows that when we are looking at arithmetic mean, so in this column you have PEs with outliers, right column you have no outliers. So arithmetic mean is hugely influenced by outliers. The median is hardly, in fact it's not influenced in this example, and the harmonic mean is influenced but only a little bit. Look ahead bias. Now, I don't think this is hugely important, but it is something that you probably saw at level 1, so you might as well learn what it means. When backtesting, be aware that time lags in reporting of financial results create potential for look-ahead bias. What does backtesting mean? Let's say you have an investment strategy where you are saying that you are going to buy based on a PE multiple less than a certain amount. So backtesting means that you apply this strategy to the past. You say that, okay, if 3 years ago I had bought stocks based on PE being less than 15, just as an example, that's a very simple trading strategy. And then you determine whether that strategy would have been successful or not. So doing that is called backtesting. But what are the risks when you do backtesting? Take an example where, let's say that at the end of 2008, January 2008, so let's say you are over here. So this is the end of 07 and you are here in Jan 08. Most companies had not reported EPS for the last quarter of 07. So actually in Jan 08, many companies have not reported numbers for the last quarter of the previous fiscal year. So at that time, a company's trailing PE would be based on EPS for the first, second and third quarters of 2007 and the last quarter of 2006, which means that if you are actually here in January and doing investment based on PE ratios, you would not be taking the PE for all of 2007 because the data is not available. Any investment strategy based on the trailing PE that used actual EPS for the last quarter of 2007 could be implemented only after the data became available. Thus, if an analysis assumed that an investment was made in early Jan 2008 based on full year 2007 data, the analysis would involve look-ahead bias. The point being that if you are now sitting here in 2010 and you are doing a back testing, where you are saying that had I bought in January 08, and sitting over here, obviously you have the EPS data for all of 07. So in back testing, you are using all of 07 data, but somebody who was actually here would not be using all of 07 data. So the issue or the bias that arises because of that is called the look ahead bias. And the way you overcome that bias is by saying that even if you're doing back testing, you should use the data that was available at the time. If you understood this, well and good. If not, it's not a huge deal. Last point now for this reading, using screens to find stocks for a portfolio. This is not explicitly mentioned in the learning objectives, but it is an important point. We have looked at several multiples. You as an analyst might want to identify stocks based on not just one multiple, but multiple multiples. And that is illustrated over here. You have a particular analyst and she wants to identify stocks such that the PE is less than a certain number, the EV to CFO is less than a certain number, the PEG ratio less than 1, dividend yield greater than 2.5, and she gives a certain range for market capitalization. There might be a database with 100,000 stocks. And when she runs a screen with all these criteria, then she ends up with a much smaller number of stocks that she can focus on. Now, clearly the screen that she defines is based on her investment strategy and what she's after. If you look at this screen, then it appears that she is a value investor. Why? Because she is looking for relatively low PE stocks. She is looking for a relatively high dividend yield. The market cap is 1 billion to 5 billion, so she's looking for mid-cap stocks. The point being that you can combine these multiple criteria and effectively create screens, and then you can more carefully analyze the smaller set of stocks that you get by running this screen. All right, let us now summarize this reading, and it is challenging to summarize such a long reading. Rather than list every point, what I'll try and do is highlight what I think is most important. You need to understand the distinction between the method of comparables and the method of fundamentals. With the method of comparables, we are basing our analysis on the law of one price, where we say that the PE ratio or any other ratio of a stock should be the same as the PE ratio for other similar companies. What do we mean by similar companies? It would typically be companies that are in the same industry with similar leverage and so on. So if you have this, let's say we are talking about the auto industry and you are evaluating a new company in the auto industry. So you figure out the benchmark PE, which would be the average PE of other companies in the industry. And then if your target company has a high price to earnings ratio in the market relative to the benchmark, that means that your target company is not very attractive, all else equal. If the ratio is low, the ratio based on market price is low relative to the benchmark, then all else equal, this would be an attractive investment. Then we talked about the method of fundamentals, which essentially connects with earlier readings on dividend discount valuation and free cash flow valuation. But here is your most important formula, where we say that the PE ratio is equal to the payout divided by R minus G, assuming the Gordon growth model. So notice here the PE is derived based on fundamentals related to the company. Again, you can come up with this PE. This is the justified PE based on the fundamentals, and then compare with the market PE. This is the PE based on the trailing PE number. And then this is price to book, ROE minus G over R minus G. There were other formulas, but I'd say that at least memorize the ones that I'm showing you over here. These have the highest probability of showing up. Multiple definitions of PE. Remember that the segment on PE was the longest in this reading. So there is the trailing PE and then the leading PE. In the leading PE, it is which 12 months to use. In the trailing PE, which 12 months to use. There was the concept of normalized PE, which considers a whole business cycle. Within normalized PE, you can either just take the average of the PEs, or you can use the concept of the average ROE and multiply by the final book value. So just remember the fact that there is a lot going on when we talk about PE ratios. Then, given a ratio such as PE, how do you compute what the value of a company should be? So remember the fact that, let's say you have period 1, and if you have a PE of 10, then you need to be careful about what E you are using. So if you have E1, this is a forward or leading PE. So how will you come up with the value of a company? The value of a company will be the leading PE times the earnings in the upcoming period. This is fairly straightforward. Then we went on to talk about enterprise value multiples or ratios. The most popular one is EV over EBITDA. And as with price multiples, the lower the better, all else equal. For every multiple, we had a slide which talked about the rationale for that particular multiple and then also the drawbacks. And the most common rationale that we talked about, and one associated with price to book, price to earnings, was that there is some evidence that relatively low ratios tend to, or there is some evidence that stocks with low ratios tend to perform well. So that was the major item. The summary for this particular reading in the curriculum is itself 3 pages long. So when you are revising, I would strongly encourage you to do that summary. It's a useful summary. Go over the learning objectives. I've covered all the examples that I think are important, so make sure you know those examples well. If you have time, then you can also look at the other examples. You must do the practice problems, and if you have time, do practice questions from other sources as well. That is it.